In today's video, I'm going to be discussing 7 key mistakes that I see teachers making every single year. And these mistakes can cost them tens of thousands of dollars, forcing them to work longer in retirement, run out of money in retirement. So I'm going to go over each of one of these mistakes in detail so you guys can use this information to avoid making these key mistakes, build your wealth, and retire on your terms. So first and foremost, the biggest mistake by far, and it's not just teachers, it's a lot of different people, that is not understanding your benefits. Your retirement benefits are so important. This is why I dedicate the majority of my time, all the videos on this channel, to just covering these benefits. A lot of people will sometimes bring up and ask, do I talk about anything other than benefits? And while I do, the benefits are what I focus on because it makes up the majority of your retirement account. If you just step back and think about it, what are your employer benefits? It's your Social Security, it's your pension, it's your Plan 3 defined contribution plan, 403B deferred comp, your PEB/SEB healthcare, your VIBA plan for additional medical savings. So there's just so much of your retirement that is through your benefits that ignoring it and trying to focus on the investment side of things, which is what most advisors like to do, is just the wrong way to look at it. I've seen so many advisors give wrong advice because they didn't take the time to understand your benefits. They put you on some other path so they can make more money, making you work longer, pay more in taxes, pay more in fees because they didn't take the time to understand your benefits. So if they're not going to do it, you need to be in charge of your own future and be in charge of your own benefits. So let's go through your benefits. So benefit number 1 is pension. Most people know that they have a pension at this point. If you don't, just know that if you're working in Washington State, you're probably going to have some kind of pension in the future. There's different pension systems and options. Primarily, you're looking at Plan 2 and Plan 3. So those on the teacher retirement system, the public employee retirement system, or the school retirement system, they're all the same for the most part. Your contribution rates may change a little bit, but as far as how they work, payout rates, all that, they're pretty much all going to be the same. Now, those that are law enforcement and firefighters, they're on left Plan 2, a little bit different of a system. They can retire earlier. They have now a new enhanced benefit for a 10-year period of time. So that's a little different side of it. You understand how your pensions work. I'm not going to go into detail on each and every one of these in this video, but I have multiple videos on this channel that you can explore to dive deeper into that. But you need to understand how your pension works. This is also important if you're ever going through a divorce or something, because I've just helped a person recently who went through a divorce. The attorneys didn't understand the system. The judge also didn't understand the system. So the way they divvied up assets was just completely wonky. They took half of his Plan 3 pension, didn't take any of his defined contribution plan, and then they slapped him with a bill for $350,000 that he owes his wife because he didn't have enough assets to split. Why didn't you just take half of the Plan 3 contributions and not force this guy to take a huge second mortgage on his home? It would have been so much easier if the courts understood this, or if this individual understood it, so they could have divvied up the assets a little bit differently and not have to force someone to fire sale on the home if you wanted to sell it, or be forced to take on another mortgage at 7% interest. And this guy's in his 60s, so he's going to be paying it probably for the rest of his life. And it's just an unfortunate situation that probably could have avoided if everybody knew how the pension systems work and how to properly divide assets. Next benefit is healthcare. Healthcare is a huge benefit that a lot of people forget about, don't talk about. So Washington employees primarily are on 2 different systems. For school district employees, you're on SEB, the School Employees Benefits Board. This is healthcare while you're still working for the school district. Outside of that, if you're not working for the school district, you're on PEB, the Public Employees Benefit Board. Teachers that are on SEB will enroll into PEB after retirement. So you move from the SEB system to the PEB system. If you're already on the PEB system, you're going to stay in the PEB system. Now, PEB is your primary healthcare while you're employed, covers spouse and children as well. Once you separate service and retire, you can still be on this plan. Costs go up because you're not being supplemented from your employer anymore, but you're still able to get healthcare from the state. Now, the healthcare that they offer is pretty good from a coverage standpoint. Cost-wise, it's going to be a little bit more expensive, but if you want to compare apple to apples, you can always go over and see what's available on the exchange. Keep in mind that as soon as you leave PEB coverage, you can't go back on. It's a one-way road. So if you want to go chase a cheaper plan early in retirement and you cancel your PEB system, and then later on those other costs go up, you can't get back on the PEB. So for the most part, all my clients are in the PEB system. They're usually on the higher end of the plan options, and they have no regrets with it. Yeah, cost hurts, but as much as they cover, if they say it's worth every single penny. Now, that PEB system will cover you up until you're age 65. After that, Medicare kicks in. PEB now becomes your second to pay. So it's PEB for retiree coverage. So you can still be on PEB even if you have Medicare. It just becomes like your Medicare Advantage plan. The cost does go down because you're not using it as your primary healthcare anymore. It's the second pay option. So those are really good healthcare options. So you need to look at if they're available to you. Next benefit a lot of people overlook is VEBA, Voluntary Employee Benefits Account. It's kind of like a health savings account, but it's technically a health reimbursement account. So for the most part, you're able to put money away into this account on a pre-tax basis. So you get a tax deduction, it goes tax deferred, and it comes out tax-free as long as you use it for healthcare expenses in the future. Now, some employers allow their employees to save into it. Most don't. For a lot of employees, the only way they get into VEBA is to roll any unused sick leave into the plan. So when you go to cash out your sick leave, they're going to give you a dollar amount, right? So it's however many unused sick leaves you have multiplied by what they determine your daily wage to be. And that's how they get the total amount. So for example, if you had $10,000 of unused sick leave that you needed to earn and you wanted to cash it out, you'd only get a 4-to-1 exchange rate. So it's worth $10,000 because I'm cashing it out. I only get $2,500. Of that $2,500, it now becomes taxable income. So I'm going to have to pay taxes on that. The alternative is you can roll that $2,500 into a VEBA plan. That VEBA plan will take that money on a tax-free basis. So you pay no tax on that money. So you keep the full $2,500 working for you. It goes into VEBA. If you want to let it ride and invest it, which you can do inside the VEBA system, it'll continue to grow. You can withdraw it to pay for healthcare at any point in the future, and it all comes out tax-free. So it gives you another way to give you some tax savings, some potential growth, and to use for healthcare. A lot of people use this to pay for healthcare early in retirement, especially if they're retiring, before age 65. Next up is your different savings options. So depending on your employer, you're going to have 403Bs if you're working for nonprofit or school districts. And pretty much everyone has the option to save into a deferred compensation plan or a 457 plan for the most part. Now, these plans, they're two different tax codes, and you can save into both of them independently. They have independent limits. So if the limit, for example, is $30,000 for the year, you could do $30,000 to 403B and $30,000 to DCP for a total of $60,000. So this is a primary benefit for people in the school district system because they have both options available to them. And if you have the means to do so, you can max both of them out and reap the benefits of each one. Now, the 403B allows you to access money at age 59 regardless of your employment status, whereas deferred comp, as long as you're employed, you can't touch that money. So there's a lot more differences between them. I got multiple videos on this on the channel as well. The thing I want you to understand at this point is that there are multiple options available to you to save in the future above and beyond what you're doing in your pension already. And you can use these for pre-tax savings or for Roth savings. So if you want to start growing your money tax-free, that's Roth. If you want to take a tax deduction now and pay taxes later, that's pre-tax, which is the default for most of these options. Final benefit is Social Security. Now, a lot of Americans have Social Security, but not all teachers have Social Security. For example, teachers in Alaska and California and multiple other states don't pay Social Security. So a lot of people take it for granted. Washington does. When you're doing your retirement estimates, you not only need to figure out what your pension is, you need to figure out what your Social Security is. You add those two numbers up, that becomes your base income in the future. So any distribution you take will be on top of that. A good exercise is always to figure out what's my base income. So worst case, if I stop working and didn't earn another dime, didn't pull anything out of my retirement accounts, what is my guaranteed income going to look like? And that's just the total of your Social Security and your pensions. And that alone will surprise most people with what their guaranteed income is if you've worked a significant amount of time for Washington State. Now, a key thing with Social Security is people get this confused with their pension all the time as far as collection ages. So Social Security has three primary collection ages. Age 62, the earliest you can touch it. And then there's age 66, 67, depending on your birth, that's considered full retirement age. All that means is the age you can collect it and still be earning an income without incurring a penalty. So if you collect anytime before your full retirement age, there's an income cap on you. You can't make over a certain threshold before they start withholding part of your benefits. And there's another threshold that once you go over that, you don't get any Social Security. So if you're working and earning more than this income, it doesn't make sense to take Social Security early because once you start collecting Social Security, you don't get the deferral credits. Every year you wait past 62, your benefit increases up until your full retirement age. Now, the third age to know is age 70. That's your max Social Security age. So that's truly the most you can get from Social Security. Your Social Security benefit increases by about 8% per year between your full retirement age of 60, 67 up until 70. So some cases it makes sense to wait, others it really doesn't. So those are the three things you need to know. I hear a lot of people mixed up that they can't get their pension until 67 or they have to take their Social Security at 65 because that's what the pension number is. Remember, they're separate benefits, separate limits. A lot of people get the ages mixed up. Next benefit we're going to go over is Medicare. So remember, Medicare doesn't begin until age 65. They have Part A that begins, which is free. All you got to do is enroll in it. And then Part B begins basically whenever you want to enroll in it. You can enroll in it as early as 65, but if you're still working and covered by your current employer or if your spouse is currently covering you, oftentimes you can just defer that coverage to a later date. Now, the amount you pay for Medicare Medicare is directly tied to your income. So the more you make, the more you pay. There's a base level that everybody pays, and then once you hit a certain threshold, you start earning more, or you start having to pay more. And when you go over just by a single dollar, that payment increase is locked in for the 12 full months for you and your spouse. And those jumps can be as high as $70 or $100 or more per month. So this is something you really need to watch for retirement. They also have a 2-year look back period. So if you're making bank, let's say you're making $200,000 a year at 63 and you don't retire to 65, you still may be paying higher premiums for your Medicare because they're going off of your wages from 63, not what you're currently making at 65 now that you're retired. Other benefit I'll just mention because some people bring it up for some reason is Medicaid. Medicaid is like a last resort option. This is primarily meant for the poor, those with no assets. Typically, you have less than $2,000 or so to your name in order to qualify for this. Now, there are some exemptions stuff that your spouse can keep, as much as maybe 30, 40,000, something like that. But the key is this isn't something you should really be banking on or think that it's free healthcare, because it's definitely not free. You have to spend down all of your money to get under these limits just to qualify for it. And even if you qualify and they start paying out, that's not free. They're going to come after your estate down the road. They'll put liens on your house and do whatever they can to recoup the money they pay for healthcare. So Medicaid is something you want to avoid at all costs. But I've heard multiple people kind of bank or rely on that or think that that's an option for them for some reason or another. All right, so that's step one. So the various benefits you guys have available to you. Now, mistake number 2 is the procrastination. This one we see all the time. And time is the most valuable resource we have on earth. But a lot of people will put off their savings or their goals until later because they're so busy chasing, I'm saving for a house, I'm paying off debt, whatever it may be. The sooner you invest, the more money you'll earn, and it's going to be harder to catch up to later on in life. So for example, someone that puts away $250 a month for 30 years and earns just 6% on average would have about $251,000. But if you decided to do nothing for the first 10 years and you just started, 10 years down the road, so you only save for 20 years at that same rate, you only have about $115,000. You have about $146,000 less saved. Even though you only missed $30,000 contributions, there's $100,000 growth that you missed out on of free money because you delayed waiting for those 10 years. So we see this in multiple ways. If you're purchasing a house that's a little bit out of the budget range, if you're buying a car or something like that, it's the payment's higher than it should be, that's easily $250 a month that you're giving to them instead of yourself for the future. Now, at this point, I paid off some debt, let's say. Now I'm going to use this extra cash flow to put up and I'm going to catch up or make up for those last 10 years. You can still do it. But if from a payment standpoint, if you're going to earn the same interest rate, you now have to put away $544 per month for 20 years just to get the same $251 a month that the other person had. So you're going to have to double your payment for 20 years and hope the market is this averaged out to be the same. Remember, you have 10 less years working for you, so there's a little less room for error here, just to net the same results. So the earlier you can start saving, the better. Remember that building wealth isn't something that happens overnight by accident. It's done by an intentional and just consistent habits of just saving each and every month, having to put off things that we really want to do. That's just a sacrifice you make for your future self. Now, beyond savings, procrastination really hurts retirees. So I see a lot of people that they get to the one more year, or I'm going to work one more year. I need to save a little bit more. And they just keep waiting, and they procrastinate their actual planning phase or actually physically looking at their benefits. And oftentimes when they get to the point of retirement where they are talking to us, they're like, I wish I was talking to you earlier. I would have retired 3 years earlier had I known this. They were just too busy procrastinating, going through day-to-day life, not really looking at the benefits, thinking that they're not where they should be. Retirement is not possible for them. But once they took the time to actually go through the steps and look at things, it was not only possible, but they're way past due. And those are years you can't get back. Same goes with tax planning. A lot of people will put off looking at taxes or thinking about tax strategies until they're way down the road. In fact, if an advisor or CPA isn't bringing this up with them, they'll probably never ever look at it. But tax planning is the easiest way to save 6 figures for most people in retirement. The little steps done each and every year in a strategic manner can really add up to big benefits in the future. Now, my last point, procrastination, will tie into the insurance part. So one thing that I feel like everyone really needs to have is the proper insurance coverage, whether it be life insurance, liability coverage for your cars and homes, long-term care plans. We need to have these type of coverages in place. Remember, insurance is a transfer of risk. If we don't have the proper insurance, we're on the hook for it. And if we don't have enough money saved, that's going to replace our income, replace the car, replace the home that we lost. We need to transfer this risk in the form of monthly payments to an insurance company so they can cover us for the other portion of that money that we don't have. A lot of people will procrastinate in doing these type of things. They won't review the proper coverages. They'll go and buy whatever is cheap, whatever is easy, and oftentimes not the right level of coverage. And they procrastinate ever seeking guidance on making sure that things are done correctly. Or they go and get cheap life insurance, and they don't understand that term insurance that expires 20 years down the road when they're mid-40s is going to be a lot more expensive and hard to qualify for if you still need that coverage, which most people do. So don't procrastinate on getting the coverage in place, but really don't procrastinate on making sure you're getting the right coverages in place. Now, mistake number 3 is failing to increase your retirement savings. So oftentimes people will start saving in accounts, whether it be Roth, DCP, whatever it is, and they'll pick a dollar amount, $100 a month, $150, $300, whatever it is. They'll have a set dollar amount and they'll stick to it, and it comes out automatically. They don't think about it, which is great. But you fast forward 2, 3, 4 years down the road, they've never changed it. They're still saving the same amount every single month. Now, if your wages haven't changed, that's probably fine. But for most people, especially Washington State employees, especially those that are teachers, where we know we're going to have a pay schedule ahead of us where we can calculate our increases. If our wages are going up, but our savings are staying stagnant, that's really not going to help us in the long run. We're no longer saving the amount we should. And that leads to something called lifestyle inflation, where basically all the new income you're earning just seems to be being spent. We start enjoying a little bit more luxuries. We start going to eat out more, buying more expensive food, going on more expensive vacations, taking more vacations, taking time off work. It doesn't end. So oftentimes people that struggle finding a dollar to save when they're earning $50,000 are the same people that can't find an extra dollar to save making $200,000. So the easiest way to get around this is to set up a reminder on your phone that at the beginning of the year, beginning of the school year, wherever it may be, review your income and adjust your retirement savings. If you want an easy way to do this, for those that are saving into like a deferred comp 403B, some payroll will let you do a percentage. So if you said, hey, I want to save 10%, it automatically will increase your retirement savings as your income goes up. Just like people on plan 3, you elect a percentage, you don't elect a dollar amount. The same can be done with your 403B or deferred comp. So just reviewing your savings and making sure you're saving enough is a really good habit to get into. Now, mistake number 4 that we see is not getting a second opinion. So a few years back, the Mayo Clinic conducted a study in which people got a second opinion from another doctor about a condition. Now, 2/3 of them got their original diagnosis redefined. So it was something else or something different than what the original doctor told them it was. And about 1/4 of them got a completely new diagnosis that the first person missed. So whether you're dealing with doctors, lawyers, or financial advisors, getting opinions from other professionals matters. Now, when it comes to your life savings, it's really important that you hire the right professional to guide you with that, and don't just hand over your life savings to the cheapest guy out there or some guy just because he's down the road. That may not be the best bet. If you really want the best thing for yourself, for your future, you need to seek the expert that has your best interest in mind, regardless of how close they are in proximity, whether they're virtual, in person, or what their fees are. The thing to understand is advisors, like most professionals, know that when they get good, they charge what they're worth. The financial professionals that may seem more expensive on the surface have been around the block or two, and they're not scared to charge for the value that they provide. And if they weren't any good, they probably wouldn't be around anymore. So they're charging because they know what they're worth. And what you're paying for is that peace of mind, that expertise that those cheap guys probably going to deliver on. Usually when you pay for a cheap advisor, you're not going to get the same quality of service. You're probably going to get some kind of product pitch at the end. Because if they're doing things for free or very cheap, that's probably not enough to live on unless they're doing a tremendous amount of volume, which most aren't. So paying extra for the right professional can be a really big difference maker. Case in point, I started getting involved in the crypto market about 4 years ago. I paid money, got a certification on it, learned some stuff, but I still need a lot more. So since that time, I've hired multiple different coaches, joined groups to increase my education. Most recently, I paid about $10,000 to a different crypto group to show me a couple different strategies I wasn't quite sure on how they worked. I dabbled with my own, had minimum of success with it, but I ended up fronting $10,000 for a 3-month contract for this guy to meet with me once a week to give me all of his expertise. And about 2 months through that contract, and the level of knowledge and expertise I've got is just worth 10 times more than what they charged me. In fact, I've already recouped all of that money and then some that I've already paid to them. So when you hire the right expert, regardless of what their price is, oftentimes they're going to be well worth it in the terms of what you're going to get back from them. Now, it's not always investment returns you're getting, but the level of knowledge and simplicity and just peace of mind that they can provide is well worth it. So it's important to get second opinions. Just to give you another example, there was a client of ours that came to us. She already had an advisor, worked with them for a very long time. The advisor had all of her money, had all of her mama's money. Came to us because she was told that she needed to save more money. She needed to do a 403B, and her advisor didn't do that. He told her that she would basically have to work until 65. She didn't have enough to retire. But within about 15 minutes, I knew that the advisor was wrong because he never understood the benefits, right? Going back to problem number one, he had no idea what a pension was apparently, or how much she had with the state, never looked at it. He only looked at her IRA balance that she had with him, and he said he didn't have enough to retire. Once you actually added in what she had outside of his IRA and what she had as a pension, not only was she on track to retire, she was on track to retire earlier and make more money than she was currently working as a teacher. And this is all figured out in 20 minutes just because I knew what to look for. So just because you advise for a long time and they're telling you something doesn't mean it's always true. Go ahead and seek a second opinion because you may be surprised in what they find. Mistake number 5 is taxes. Mistake number 5 is really not understanding the different tax strategies that are out there and really just knowing how every asset is taxed. Every dollar that we touch or move has some type of tax implication on it. Primary buckets that you guys will have from a tax standpoint are going to be pre-tax accounts, or what we call tax deferred accounts. This is money that has not been taxed yet. You probably got a tax deduction for money in there. You're going to be taxed down the road. There's after-tax buckets. This is like a bank account or some type of investment account where the money's already been taxed, but any type of gain I get will be taxed. And that can be either capital gains tax at a favorable rate, like long-term capital gain rates, they're like 20 to 15%, lower than most ordinary rates. There's short-term capital gains where you pay the just regular taxes on there. And they also have dividend interest, which again is taxed at the ordinary tax levels. And then you have Roth accounts, which are tax-free. So I pay taxes on the money now, but the growth is tax-free. So those are the primary 3 different ways your money gets taxed. Every time you touch money, there's some type of tax implication on it. So it always blows my mind when people are making tax moves, whether on their own or advisors giving advice, and they never reviewed a client's tax return. If you don't know what the client's tax return is, how can you tell them if the pre-tax route is going to be better than the Roth route? Or you can tell them how much to convert without tripping over certain tax thresholds or triggering additional Medicare taxes. They usually simply don't. Why a lot of those people won't ever give tax strategies. They'll keep telling you to save, defer, and then keep collecting their fee. So if you want to get ahead of the IRS, you need to have a professional that isn't afraid to dive into tax strategies, look at tax returns, and give you actionable advice on what's going to be best for you and your family in the future, not just what's going to line their pocketbook. Now, one of the biggest mistakes people make is they retire and they will withdraw money from their pre-tax accounts. Let's say it's Plan 3, for example. They just withdraw money every single year, and that's that. They never do anything above and beyond that. So the problem with that is you probably will end up paying a lot more in taxes. So case in point, someone that, let's say they start working at 35, that saves $5,000 per year, and let's say that grows at 7%. You fast forward to 30 years to 65, that money would have grown to about $500,000, $528,000. That's all pre-tax money. We haven't paid a dime in taxes yet. Let's say they actually didn't draw this money because they had enough income from other sources. So that ride up until the required minimum distribution age. So all pre-tax accounts have required minimum distributions, which is the IRS forcing you to take money out whether they want to or not. So let's just say, faster down the road at age 72 in this example, that they're forced to start taking money out. And their forced amount at 72 was about $27,000 off of total balance of $700,000. So remember, we went from $528 to $700. Just because you're retired not putting money in doesn't mean the account stopped growing. They still earn interest. So if the account started growing at, let's say, 5% instead of 7%, and we're not adding that $5,000 per month, it's still going to grow. When you have $500,000, it doesn't take a lot of interest for that thing to grow even further. So if you start taking those retirement distributions out and you took $27,000 out, you're $28,000, fast forward to age 85, your withdrawals would have been over $518,000 that they're forced to take upon you. But because that money is still growing, interest, we took $27 out at age 72, 5% growth would have been $34,000. So basically what I'm getting at here is there's a point in the future where if your account gets too big, the RMD isn't going to be enough to offset the growth. So the account's going to keep growing, which means RMD is going to keep growing because it's based off a percentage. So as your account goes up and up and up over time, the RMD also goes up. So if the money they're going to force you to take out and pay taxes on will keep going up. So in this example, they would have paid over $518,000 in taxes. At age 85, they still have $681,000 in the account. So from age 72 to 85, they distribute $518,000 because they're forced to pay tax and all that, and they still have $680,000 left that hasn't been taxed yet. So the total amount they're paying taxes on is almost $1.2 million. So that's what happens when we don't do any type of tax planning and we just defer. So the contrary to that is doing tax-free. So had it been a Roth account, Roths don't have RMDs, you're never forced to touch them. The money that grows is all yours tax-free. When it goes to your beneficiaries, it's also theirs tax-free. So just make things much easier. All right, so moving on, mistake number 6 is not using your home equity wisely. Now, if you own a home, the equity in there is really just a gold mine, and there's just so many ways you can use that to your potential. Remember that your home will appreciate in value the same, whether you have a mortgage on it or not. And if you have your home paid off and you have all the equity sitting there, you're not using it, you're really not using it to the best of your ability. There's a couple ways you can unlock it and use more. Now, a lot of people are just so worried on the whole debt-free. I need to be debt-free and get my home paid off. They don't understand why that is. Now, really, it comes back to the Great Depression. That's back when a lot of people were buying stocks on margin. So you basically put 10% of the stock price down, you borrow 90% of that stock price from the broker. But when the market crashed in 29, they got margin called. It says, hey, you owe us all this money back that you borrowed. People don't have the money, and when you don't have the money, that's when people have to go to the bank to get their money out just to try to pay these things down. And that's when you start having what they call run on a bank. So when people start all withdrawing their money all at once, and that causes the banks to go down. So that's back when the Great Depression happened. So during that time period, about a third of all the banks in the United States went bankrupt. Now, in order for banks to avoid going bankrupt, they started calling their mortgages back. So when a bank calls their mortgage back, they say, hey, that mortgage is due now in full, or we're going to foreclose upon your home. And if you don't have the money to pay off your home right then and there, you lose your home. So you made up all your mortgage payments, the bank has still come to you, you end up foreclosing upon it just because you didn't have the amount to pay up front. So that whole mindset is why a lot of people say pay your home off to out of your home. But remember that today's markets are a lot different than they were in the 1920s. We have the FEC insurance. A lot of the contracts are done by federal backed loans. They're non-callable loans. They're fixed interest loans. And most people don't trade on margin anymore. So it's a lot different than it was back then. So as far as accessing your home, there's a lot of ways you can do it. There's HELOC, but it's a line of credit where you can spend the money down almost like a credit card, pay it back anytime. So that's just one way to unlock. A lot of our clients will use this as an emergency fund. So if you don't want to have a lot of your retirement funds locked up in cash, earning nothing, you're going to have it invested, a lot of times you can just have a HELOC on the side. So if something really does go wrong, or if you really need a big purchase like a car or something, you could put on the HELOC, pay that back over time. Typically, you're going to get better interest rates than you were if you're trying to go get a new car loan. It's better than selling off your stocks and losing the interest on it. It's better than taking money out of a retirement account, paying a bunch of taxes. So HELOC just gives people a lot more options of where to take money from. If you're really in a pinch, you need more, that's when cash out refinances come, where you can refinance your home and get a big chunk of change out of it. So yes, you have a mortgage again, but now you have all this cash that you basically just got for whatever the mortgage rate is that you can use for any purpose you need. Most times we're using the strategy, it's probably going through something like a divorce where they need a lot of cash on hand. It's really good for people that are waiting for college, because if you have a mortgage, that shows up as a debt on your financial statement for the colleges. So if you show them a large amount of debt, it's going to offset some of your assets. It may make your student look a little bit more needy in terms of their eyes, versus if you didn't do that and you show a mortgage statement with $500,000 equity in your home that hasn't been tapped yet, you're not going to be as likely to get money from the institution because your student doesn't look as needy. So it's a strategy that could be used to maybe tip the scales in your favor. But regardless of that, taking cash out from that rather than, again, cashing in, any type of investments to pay for school, using cash to pay for school, oftentimes makes a lot of sense. And finally, mistake number 7, above all, is not having a plan. So all these mistakes we went over could all be addressed if people just took the time to get a plan in place. Financial plan should cover 5 key areas, which is your income, taxes, your estate planning, risk management, and your investments. Most people that do their own financial planning focus on investments, and that's about it. They don't think about anything else other than, I want to get the best return I can, I want to pay the lowest fees I can, and that's pretty much all they look at. They might look at income a little bit, but never to the degree that a financial professional whose job it is to make sure that when you retire, you stay retired, is going to look at it. So get yourself a plan in place, run into different scenarios, because there's a world of things that can change, that can throw off your plan. And if your whole plan is, I'm just going to save a bunch of money, pay least amount of fees, and cross your finger and hope that everything goes right, probably not going to go as well as it could be had you taken the time to get a proper plan in place. Doesn't mean you have to hire a financial professional, to manage your money. It just means they do the planning for you. They do all the work that you probably shouldn't be doing on your own. Just like when you go to pay for a doctor for their time, you're paying for them for all their years in med school to give them their expertise, right? So rather than you spending countless hours on Google and, running through podcasts and YouTube videos, trying to understand and study and apply all these things to your own, you can just, pay that professional to do it for you. That way you go and do your own business. They go do all the research for you, put it together. Then you get a plan that works right away. It's probably the best use of your money and will save you the most amount of time in the long run. So getting yourself a plan is really important. Now, as important as a financial plan is, it's really the planning process that makes it worthwhile. Because you can get a plan and it can blow up the next day. Because as markets change, as situations change, these things are not just static documents. They're things that need to be updated annually. So as in the words of D.Y. Eisenhower, he says, plans are nothing, but planning is everything. So it's constantly adjusting your plans to what's going around you. That's going to give you the best chance of retiring and hitting your goals. So that's the 7 key mistakes that I see people made. All this that I went over is actually a part of my book called The 7 Money Morning Mistakes That Teachers Make. I'll put it in the description below. Feel free to download that for free and read through it. It's got a little bit more examples, pictures, and things like that in there to help all this make sense. Until next time, remember that your future depends what you do today.